Welcome to the Fintech One-on-One podcast. This is Peter Renton, Chairman and co-founder of Fintech Nexus. I've been doing these shows since 2013, which makes this the longest-running one-on-one interview show in all of Fintech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, Pitch It, the Fintech Startups podcast with Todd Anderson, and Fintech Coffee Break with Isabel Castro. Or you can listen to everything we produce by subscribing to the Fintech Nexus podcast channel. Before we get started, I want to remind you about our comprehensive news service. Fintech Nexus News not only covers the biggest fintech news stories, our daily newsletter delivers the most important fintech stories into your inbox every morning, with special commentary on the top story of the day. Stay on top of fintech news by subscribing at news.fintechnexus.com/subscribe. Today on the show, I'm delighted to welcome Mike de Vere. He is the CEO of Zest AI. Now, Zest have been around for over a decade, and they're one of the most experienced AI practitioners out there when it comes to underwriting models. So we obviously go into some depth about what they do and how they are able to create these models and what types of lenders they're working with. And let's face it, AI is hot right now. It's hot in all kinds of different areas, and it's also hot in underwriting. And Mike talks about that. We talk about automation. We obviously talk about bias, explainability, and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Mike.
Hey, thanks, Peter. Good to see you.
Good to see you. So let's kick it off by giving the listeners a little bit of background about yourself. I know you've been at Zest for a little while, but tell us some of the highlights of your career to date.
If you look across my career, nearly 3 decades now, just had a big birthday. It's been around taking data and translating into insight. And so early on in my career, working at JD Power when, it was nearly a startup, and leading the effort around customer satisfaction and guest satisfaction, transitioning from that into actually having a wonderful startup that I chose to launch right during the Great Recession. That was a wonderful idea. And then from that over to the Harris Poll, again, data into insight, where we successfully exited that business, sold it over to Nielsen, where I led their insights business for North America and Europe. And I find myself here as the CEO of Zest AI. I'm almost at my 5th anniversary coming up here in the fall.
Okay, so what was the thing that first attracted you to take a job at Zest?
Well, it was the snappy name for sure.
It is a snappy name.
So, who doesn't like Zest, a fresh perspective on credit?
Mm-hmm.
But, really the mission spoke to me. I've had a lot of years and being able to do something that's meaningful. Guest satisfaction, customer satisfaction is important. TV ratings are important. Understanding the pulse of America through the Harris Poll, that's important. But actually having a business where we're actually able to help businesses do well by doing good. That's the thing I think that excited me the most.
Right. And we did have your predecessor, Douglas Merrill, on the show back, I think it's 4 years ago now. Would love to kind of get a sense of how is it you describe Zest today?
Zest AI technology automates underwriting with more accurate and equitable lending insights. So AI can be used in the entire customer journey. We're focusing in on the topic of underwriting, but we want to automate it so that a member experiences, I submit a loan and a second later I get a response and I understand why the loan has been dispositioned as a yes or a no. At the same time, we need to make sure that those decisions are smart and that they're accurate. And smart means you're not only being able to expand access to more members, but it also means that you're also protecting with charge-offs. And so certainly in today's economic time, that's a critical factor. Equitable is ensuring that, simply every American deserves a fair shot. And so is there a way to assess credit worthiness and ensure that all Americans are treated the same way?
And so what types of lenders are you working with? I know you've been big in fintech for a while, but I know you've got some traditional lenders as well. Tell us a little bit about who you work with.
Well, we actually cut our teeth on largest, most regulated financial institutions on the planet. So you look at Freddie Mac, Discover, Citi, things of that nature. I think the thing that we're most proud of is not only all the innovation and work that we've done with those larger financial institutions, but that we're able to make this automated underwriting enabled by AI accessible to even the smallest credit unions. I'm just back from a trip from Hawaii. I had an opportunity to meet with the CEO of Molokai Credit Union, and they probably do 15 applications a month.
Wow. Okay.
That is, if you think about where Zest has positioned itself, because we have been perfecting the use of AI for nearly a decade and a half, we have been able to automate and tool our technology such that it's truly accessible to those smaller financial institutions. It's important because they're competing with the big banks and the fintechs and things of that nature.
Right. Gotcha. You guys have been doing AI for a long time. I remember Douglas talking about it 10 years ago. And what do you make of the current state of, particularly in the media, the conversations around AI? AI is everywhere. It's happened, obviously, ChatGPT came out, but I just would love to get, for someone who's been living this day in, day out for years, what do you make of the current, I don't know, AI craze, shall we say?
Well, certainly great for business, I'll tell you
Right.
And so, 8 out of 10 financial executives last year indicated that they wanted to leverage AI within their underwriting process. And so it's very helpful. It certainly has created a lot of questions. So the type of AI that we're doing here at Zest is it's not generative AI where it's not like the Terminator and you've got Skynet that's up and running on its own to try to assess credit. No, it's a moment in time where we're training on a set data set so it's fully explainable. So I think it's created some additional questions, but certainly has helped us from an interest and excitement perspective. Very good for business.
Okay, well, let's talk about explainable AI. You've mentioned it a couple of times already, and it was a really hot topic, 3 or 4 years ago. It seems like people are talking about equitable AI and all when it comes to underwriting a lot now. I don't see the focus on explainable AI like I did a while ago. Does that mean it's a solved problem, or where are we at with explainable AI?
Well, I think from an academic perspective, explaining a model and why it's making decisions is a doable. It's open source. Mm-hmm. The question is can you operationalize that for underwriting? And so what does that mean? That means that from a computational perspective, you need to be able to apply the approach to explainability and get reason codes back to a consumer or customer in less than a second. So that's a big hurdle. And I think that's where Zest initially set itself apart. But what we've also become aware in our next release of for our explainability, which will be announced, well, it's being announced right now, that there are some blind spots in the open source explainability approach where consumers are not getting the right reason codes. It's really critical that we protect the end consumer. That's a part of who we are as an organization. And so I'm really proud of the work that our data science team has done, as well as our new patented approach to explaining a model, such that those blind spots now have gone away.
I just want to dig into that just for a little bit. So you're saying that there are some AI models out there that when they're declining someone, the reason they are saying it is actually incorrect or invalid. Can you just sort of dig into that a little bit for us?
Yeah, and it would be almost not understandable to the end consumer.
Okay.
So you'll get not only either a wrong explanation in some of these blind spots, but or at times it just won't be understandable. And the fact of the matter is, within the fintech spaces, we need to do better. We need to have our eye on, we're a business, we're a for-profit business, but at the same time, we have a responsibility to that end customer to fully understand and fully explain that model itself, as well as give that end customer a reason that they can do something about. Right. In the end, that's what it's about. Is I want to know as an end customer why I was declined for a loan, so I can do something about it. So it needs to be understandable.
So it sounds like your new product, which obviously we're happy to link to it in the show notes, is there have been blind spots in the past, and now you're saying they have all been filled in. Is it 100% now, or what's the status?
Yep, we've solved it.
Okay. That is great to hear.
Yeah, for anybody who gets excited about news around calculus and statistics, this is exciting. So,
Excellent, excellent. Okay, so one thing that isn't solved, though, I don't think, is bias in lending. And I'm curious to see what you have to say about that, because this is a hot topic still. Where are we at as an industry when it comes to removing bias from our AI models?
I'd say there's work to be done. And so it starts with the data that we're using, ensuring that it's actually representative of the US population, of the group that you're trying to build the model for. I think that the signals that go into the model, it takes a really strong compliance organization that just because the model wants to use a particular variable, is it compliant? Is it safe and sound? Is it fair to that end consumer? But then there's frankly technology. And so we have a patented approach where we look for less discriminatory alternative models and imagine that there's this efficient frontier, Peter, between equitable or fairness on one side, accuracy on the other. We generate many alternative models and are on the constant search for that model that is both more fair and more inclusive, or at least giving visibility for that financial institution so they can understand the trade-offs. We will be releasing our new Fair Boost approach, which we're really excited about. That there's a few kind of major step forwards in that approach. In particular, we're seeing a lot more free trade-offs where you can be both more accurate as well as more equitable and inclusive. And so that's yet to be announced here soon. But the data science and all our mathematicians here have been really cracking at it. But in the end, it's this belief, and it's part of our DNA as an organization, that you have to be purposeful. You have to be purposeful about the people you're hiring, all the way through to purposeful about the model you're building itself. And there are organizations that don't have that same spirit.
Right. Gotcha. Okay. I want to just talk about the product suite you guys have. Maybe you can give us a bit of an overview. Is this sort of an a la carte type offering that you have, or is there like a comprehensive thing that goes in and kind of replaces something? What is it that you actually provide?
If we segment the market in three, there are three different offerings. So our enterprise offering would be our most highly customized and tailored solution. That will tend to be the large banks, large financial institutions, where we will work hand in hand with them, usually building a first pass model, but in the end, actually handing over the reins to the Zest AI technology and giving them a platform where they can continue to build, document, do fair lending testing on their own. So it's a bit of teaching them to fish, and then they're off fishing themselves. Our pro segment, which constitutes probably the largest segment, is where Zest is truly building the model directly for that end client. It's still tailored, but we have an automated process where we're able to build the model within days. And just to give you, context, I think the first model we built took us 14 months. And now we're able to build the model and fully document it within days. That sets us apart from any other fintech company out there, where I think if we're at 250 plus models in production. I don't know of a company that even comes close to that. And then finally, the select offering is that long tail where we're developing these regional, very standardized models, but it makes it accessible at a price point that a smaller credit union or financial institution could access.
Right. Okay, so then the 250 models you said you have in production. So someone comes along to you, what are you customizing exactly? Do they say, because everyone's going to have a slightly different credit box, I imagine, but what is it that you're customizing? I imagine you're obviously integrating with a variety of different loan management systems. What are the differences that your customers want that you need to customize?
Well, let's first start off with the geography. And so there are some out there, certainly the big industry scores are a one size fits all. Mm-hmm. It's a national model. And, speaking of Hawaii, Pacific Islanders, the question I would have, are they fully representative and a national score? And so would it not be better if you're talking about Hawaii, USA, the largest credit union on the island, if I had a model tailored to the Hawaiian Islands and trained it off of that data set? So that's one part. Gotcha. Second is the business line. So looking at secured versus unsecured. So looking at auto versus personal loans, credit card, each of those will have different signals based off of the business line that they're trying to address and what their business objectives are. And then finally, as you touched a bit on, it goes to what they're trying to do as a business. And so a lot of financial institutions we're approaching, in particular today, are unfortunately trying to shrink their credit box over to A to protect themselves. It's like kind of the easy to predict, but they're not serving their full customer base. And so their objective is to train a model such that they can safely move down the credit spectrum and serve their full member base during this difficult financial time.
So can we just dig into that for a second? How are you helping these credit unions or any kind of lender expand their credit box? Is it what kinds of data, I guess, are you bringing into the models?
Well, so we stick with FICRA compliant, so raw trade line data from the bureaus is kind of our base ingredient to any model that we have. And what we've discovered over time is that with our technology, we're able to support a lender in being able to, just with that, lend down the credit spectrum. And so if I give the opposite example, we did some research on the Great Recession of 07 and 08, built a time machine, went back to 2006, built a machine learning model and decision through 07 and 08. And what we discovered is that if you're using the old approach, the industry score only approach, it's nearly a coin toss in the B, C, and D credit tiers. But machine learning still is able to predict and understand who to give a loan to in those middle credit tiers. So it's just smarter by consuming more credit data. That doesn't mean that alternative data doesn't have a role to play. Certainly it has a role to play with borrowers that have no file, but you have to be careful. You have to make sure that that alternative data is safe to use because we don't want to inadvertently add bias to the lending process by adding some of the wrong elements to alternative data.
Does that mean you do add elements of alternative data?
What we actually do with a waterfall approach where we will start with raw trade line data, build the primary model off of that. And then if we get a no hit where they actually don't have a credit file, it waterfalls out to our alternative model.
Right. Gotcha. Okay. You have an advantage because you've been around for so long. You've said you've had a lot of experience with producing models, and AI is supposed to get better over time. How have your AI models improved?
Well, I think there's a few different ways. I think, the senior point around the efficiency with which we're able to deliver models, I think is good from a commercialization perspective. But it has the secondary benefit from a end customer's perspective because we're able to adapt quickly to changes in the marketplace. Mm-hmm. And so we build smart models. Our first model was also smart. The difference is if President Biden decides to send out $2,000 checks to America, how quickly can a fintech respond to that? Or how quickly could the largest financial institution that's so proud of the fact that they have their own data science organization and they're doing all their own models, how quickly can they adapt? I don't know that I've run into a financial institution that's already adjusted for the changing economy. And so here at Zest, we are every day monitoring our models and understanding potential feature drifts. And when there are changes in the economy or changes in the marketplace, we're able to adapt quickly. And so for me, that's probably the greatest innovation beyond the really smart models. It's the ability to be agile within the marketplace.
Yeah, because let's go back over the last, 3+ years here, because it hasn't been a normal economy, shall we say, since from, 2019. And I imagine for someone running an underwriting model, it can be a little frustrating. We're in a very different situation than we are now than we were a year ago, and it was very different a year before that. Like you say, you do this quickly. When you see changes out there, what are you doing exactly, and how quickly are we talking?
So we can redeploy a model overnight. And so if we sit down with the credit risk team and understand that this alternative model is more accurate, more stable, given the current environment, we can redeploy overnight. And that just helps our customers stay ahead of what's next from an economy perspective.
So then, can you just explain, if someone's listening to this and they're interested in what you're talking about, can you explain what's involved from someone who they may have just run something off the shelf, they may have a FICO model or whatever. What's involved in implementing Zest into a lender?
It's about an hour is what I would about an hour. In all seriousness, Peter, sitting down with the lending team and understanding, much in the same way I called out the differences on how we tailor and customize a model, it's asking those questions. What are the communities that you're trying to serve? What are your aspirations from a business perspective as far as the credit tiers that you'd like to serve versus the ones you're serving today? What are the business lines? What's the value of a good loan versus a bad loan? What are your charge-offs? So it's a lot of background information. A few days later, we come back with a tailored model for that customer to review. Notice there's no contract. Notice there's no big due diligence. We actually build the model at no cost. Because what we have found in particular over the last 2 years that's given us this great momentum is by focusing on an automation and being a scale up, not a startup. Because as a scale up now, I'm able to sit down with chief lending officer and say, over the last 18 months when you were using that industry score, here's how you performed. If you had been using this very machine learning model over the last 18 months, here's what your approval rates would have looked like. Here's what your charge-offs would have looked like. Here's what your yield would have looked like. And oh, by the way, let's not lose the efficiency gain, because if you're able to increase your automation from 20% all the way up to 80%, imagine the resource efficiency you'll have in your underwriter and fulfillment organization. So it becomes a very easy engagement for a customer to understand if AI is right for them. We take the guesswork out.
What is the thing you have to overcome then? I mean, because it seems like the way you describe it, if they're running something that is off the shelf, it seems like a no-brainer. But I imagine you don't have every single lender in the country. So what's the pushback you get?
Give us till the end of the year. No. So I think the thing that we run into, our conversion rate is exceptional. I've not worked at a company with a conversion rate like that. Once you have a model in hand and a chief lending officer or CEO is looking at a 5 to 10x return on their first year investment, it's a pretty compelling business case. The challenge is there's also 5 other business cases that are out there that may have been planned out the prior year. And so oftentimes it is a prioritization effort. It's not a no, it's a win, I would say. I'd say there's also some fear of change. Even some of the largest financial institutions we will work with, even though the numbers say it, but they've been doing it the same way for 20 years.
Yeah.
So getting them off of that and admitting that there may be a better way, using a math that was likely created and or taught decades after they were out of school, is a bit scary for some. So there's the human component.
Right. So I want to talk about automation for a second. You mentioned it a couple of times. Is 100% automation possible? Is that what people want, or do they just want to increase on what they're currently doing? And how does it actually work?
So let me unpack how it works, and then we'll get to the aspiration. And so once you have this smart and inclusive AI underwriting model, the question is now how do I operationalize it? Most lenders will have 20 to 30 credit policies that they have traditionally overlaid on top of an industry score. That's kind of like the duct tape and chewing gum approach of like, how do I make this score actually work? And it's all the credit policy that they overlay. What we then go to do, because as we're really a technology as a service company, this is where the service piece comes in, is our client success team is working with them on their policies to understand. Let's, for example, say they've got 25 policies. Usually about 15 of those policies, like debt to income, for example, those are signals that we already included in the model.
Right.
So you can scrap those. And then we'll find that there's, 5 or 10 that actually have no signal. And when you ask the chief lending officer, why do you have that policy? It's usually, well, we've had it in place, the guy before me for the last 20 years, so we've often thought to have it in the place. And so those then get cleared off. And what you end up with is this optimized policy. And so fewer things, once the AI has decisioned and come up with a yes or a no decision on the loan, there are fewer things that are getting kicked out for manual review because there's fewer policies that are catching it there. When we look at most of our customers, as I mentioned earlier, it's 25% auto decisioning. The goal with our customers is to reach 80. 100% is possible, certainly with the likes of a credit card. So we have a number of customers who are at 100%. And so why is that critical? It's critical because they're out there competing with big fintechs and big banks who have significant resources. And so how do they set themselves apart? It's through that speed and agility within that marketplace.
Right, right. But then going back to sort of the Molokai Credit Union that's doing 15 loans a month, is automation a really critical thing? If you're only doing 15, is manual review acceptable?
Well, the issue is the CEO probably would like to not do any reviews themselves of loans.
Right.
And so they probably like to get on to their day job. And so automation is pretty important even at 15 loans. I think that's probably a really extreme case.
Right.
But across the board, even for a small credit union or financial institutions, oftentimes the chief lending officer is also doing some underwriting. And so the ability to free them up so they can work on more policy and strategy issues is a greater value for the end member.
Right. Gotcha. Okay. So I want to talk about Washington and, the CFPB and the legislators looking into AI, and there's task force, and I think in the House Financial Services Committee. And how are you engaging with the lawmakers and the regulators in Washington?
We're engaged directly with each of the regulatory bodies, whether you're talking about from a U.S. perspective, but even also at a state level. That's also critical. Much of the ways that we're engaging is sharing and educating as far as what we're doing, because there is a right way to leverage AI. There's also a wrong way. And so educating them on both, I think, has been critical for us. We view smart regulations as critical because if we want to do good in society, we also need to protect the end consumer. And that's what the CFPB and the other regulatory bodies are out there doing.
Right. And so, with far as regulating AI, how would you do that? When you're having these conversations, what is it that is it really around bias? Is that the primary thing they're focused on?
Well, protect the consumer, make sure to give them the right reason, explain why they got the loan or why they didn't get the loan. Bias is certainly an important topic. I think, 3-4 weeks ago, the CFPB was out talking about the need for when one builds the model, as well as on an annual basis, you need to be looking for a less discriminatory alternative model. And so we're very excited about that guidance coming out and the fact that they will be formalizing that, or our understanding is they'll be formalizing that shortly, because that certainly plays to our strong suit. That's right. Core to what we do. Every model we put out in production, we are looking for that less discriminatory alternative model. And there's not a lot of fintech companies that can say that.
What's next for you guys? What are you working on that you're excited about?
Beyond kind of the geeky math stuff that I was talking about earlier, it's really around that idea of automation. And so if we think of the customer journey, there's various friction points. And so if we think on the way in, there's everything from ID verification, fraud, income verification, that tends to be friction points for that lender. And so is there a way for us to leverage AI to support the lender and eliminate those manual steps that oftentimes happen? The example just from meeting I had the week before last was a large financial institution out here on the West Coast said probably the longest part of their underwriting process is just getting the name right. There's hyphenated names in California or long names that don't conform to the fields. And so just being able to make sure you have the right person, that's a really great process where we can use AI to automate that. And so supporting them that. So it's both up funnel, but it's also down the customer journey. Once you have actually a loan and now you have a loan portfolio, how do you test the resiliency of your loan portfolio itself? And so if you've used AI to underwrite it, you probably should use AI to actually assess the resilience of your credit portfolio over time. And so that's something that we'll be launching here in the next, 4 weeks or so. But beyond that, there's also the question of collections, is that once we've determined that someone needs to shift over into that space and we get into revenue recovery, what's the best way to do that? We've got a very, very aggressive product roadmap over the next 12 to 18 months. That's really where our Series F came in, is we're doubling down on this automation.
Right. Well, we'll have to leave it there, Mike. Great to chat with you. Lots of good work done, but still lots to do, it seems. So thanks so much for coming on the show.
All right. Good to see you.
Well, I hope you enjoyed the show. Thank you so much for listening. please go ahead and give the show a review on the podcast platform of your choice and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.